Today's topic is something that impacts almost everyone throughout most of their financial life, but is still broadly misunderstood. That is your credit score. People generally think of a credit score as a measure of their financial health, and that if they make good financial decisions, it'll be reflected in a better credit score. Unfortunately, neither of those perceptions is true. So let's break down what you actually need to know about credit scores. In order to understand credit scores, it's important to understand why they exist. Creditors, that is, companies who loan people money, earn profits by giving out loans and charging interest. But that only works if the borrowers pay back the loan successfully. As a result, a major success criteria for a creditor is answering the question, who should I lend money to? 100 years ago, this decision was made by a local banker who probably knew you, your grandpa, your dog, and it was up to him to decide if you were trustworthy enough for a loan. But as the industry has become more sophisticated over the years, a more objective, scalable process was needed to help make these lending decisions. That's where credit bureaus come in. A credit bureau collects credit history information on individuals and sells that information to creditors in a credit report that's used to help make lending decisions. The US has three main credit bureaus: Experian, Equifax, and TransUnion. These companies aggregate reports about your borrowing behaviors from many different lending institutions and creditors. These reports include your payment history, account balances, when the accounts were opened, credit limits, debt collections, bankruptcies, and much more. When you go to borrow money from a creditor, they'll purchase a credit report about you from these credit bureaus to assist in their loan decision-making process. But credit histories are large documents, potentially with dozens of accounts and every payment you've ever made over the course of many years of borrowing. How does a creditor take all of this information and quickly come to an automated decision about your loan application? That's why credit scores were invented, to simplify all this data down into a single number. A credit score, then, is just a number that represents an estimated likelihood that you will pay back the loan based on all the information in your credit report. So how do they calculate your credit score? First off, it's worth noting that there is no single credit score. There are multiple credit score vendors out there who try to convince creditors that they have the best methodology for predicting who will pay back their loans. But by far, the most well-known company in this space is FICO. And since they represent 90% of the market, we'll focus there. FICO is a data analytics company that has credit report data from hundreds of millions of adults over the last 60 years. By analyzing that data, they've created models that connect many different data points from someone's credit report, correlating them with the chance that they will pay back their loan. Once you understand that they only use data from your credit report and that they're attempting to estimate the average behavior based on historical trends, you'll start to see that credit reports have nothing to do with your financial health. For example, you could have $100 million in the bank or make $1 million per year, and it wouldn't change your credit score because that information is not in your credit report. Similarly, if you paid cash for everything your entire life and never had a single penny of debt, you would have a terrible credit score because there would be no information in your credit report. A credit score compares your credit report characteristics to similar credit reports from throughout history and estimates from there how similar people would have done in repaying their loan. So with that context, let's discuss how this scoring approach can be used in your favor to give you higher credit scores. A FICO score ranges from 300 to 850, with higher numbers indicating to creditors that you have a better chance of repaying the loan successfully. Here you can see the split of how average FICO scores break down across the US population. There are 5 elements in calculating a FICO score. The largest portion of your score, 35%, is determined by the percentage of on-time loan payments in your credit report. Anything less than 99% on-time payments is going to ding your score heavily. The key takeaway here is to never miss a payment. Do whatever you can to ensure you at least make the minimum payment on time every time. A late payment will stay on your credit report for 7 years, so make sure to make on-time payments your #1 priority. Using this calculation, you'll notice that the more open accounts and the more payments you have, the less you'll be penalized for one late payment, since the calculation is based on the percentage of total payments that were on time. You can use that to your advantage to help improve your credit score by simply having more accounts and therefore more payments being made on time. The second element to your credit score, worth 30%, is your credit utilization ratio. This is a very gameable metric because it is simply your current credit balance divided by your total credit limit across all accounts. So if you have 4 credit cards with a total current balance of $1,000 and your total credit limit across all those cards is $10,000, then currently you would have a credit utilization ratio of 10%. You always want to keep this ratio below 30%, but ideally below 10% will give you top marks. Because of how this is calculated, you can actually improve your credit score by requesting higher credit limits than you need or by having more credit cards than you need, since this will make the credit utilization percentage go down. The other option would actually be to pay down your credit cards more than once a month to ensure that the credit balance always stays as low as possible. The third element to your credit score, worth 15%, is the average length of your credit history. This just takes the age of all your accounts and averages them together. As a result, it's actually better for your credit score to keep old unused accounts open because it brings up the average age. Similarly, each new account that you create can hurt your credit score since the average age will go down. 6+ years is the preferred average length of your credit history, with 10+ years giving you the maximum amount of points for this category. The fourth element of your credit score, worth 10%, is based on your credit mix, which means having both installment accounts, where you pay a set amount monthly like a car loan, and revolving accounts like credit cards that you borrow and pay off each month. Having a diversity of loan accounts actually gives you a higher credit score in and of itself. This is just another way your credit score does not line up with your financial health. For example, if you finish paying off your mortgage and close that account, it could actually have a negative effect on your credit score by reducing credit mix and likely your average credit history length. If you're asking, why would loan diversity improve my credit score? The answer is as simple as, historically, people with more loan diversity have done a better job of paying off their loans. Therefore, the credit score calculation model gives extra points to people who share that characteristic. As silly as it is, just make sure to keep credit mix in mind when working to improve your credit score. The final element of your credit score, worth 10%, is how many hard inquiries have been made to your credit report recently. Whenever you apply for a new loan or line of credit, the creditor will ask for your permission to do a hard inquiry and pull your full credit report. Fortunately, the scoring is smart enough to not penalize you for comparing interest rates and having multiple vendors pull hard inquiries for the same type of loan on your account within a 1-month period. But generally speaking, if you plan to apply for a mortgage loan, for example, you would want to avoid also applying for a credit card and a car loan in quick succession, or your scores will get dinged. So now that you know what a credit score is and how it's calculated, you're probably asking yourself how much you should care about it. The answer really depends on your financial situation. If you're fully financially independent, own your own home, don't plan to borrow any money, then it's basically useless to you. But if you have plans to take out any kind of loan, open a credit card, even rent an apartment, your credit score will be a major factor in the loan application decision and the interest rates that are available to you. If you're following good financial practices, then you're probably already making all your monthly payments on time, which is great. But if you want to squeeze the most out of your credit score, the next step would be thinking about how to raise your credit limit. In most cases, this is as simple as calling and requesting higher limits from your credit card company. And if you're early in your financial journey, you should also consider opening more accounts as soon as possible to start building up your average credit history length. Maybe you aren't sure what your credit score is right now or if it even needs to be improved. The 3 main credit bureaus mentioned earlier will actually provide you with a free credit report once per year so you can see what your creditors are seeing through annualcreditreport.com. Check the link in the description. If you pull your credit report in this way, it's considered a soft inquiry, which won't hurt your credit score, so have at it. Hopefully this video has demystified some of the strange world of credit scores and has given you some ideas that will help you get your score moving the right direction. See you next time.